On March 2nd, the Canada Parliamentary Budget Officer released their Economic and Fiscal Outlook for 2023. In this report, there was some interesting information about why the Bank of Canada might hold interest rates steady in 2023. Now, if you're coming up for renewal on your mortgage soon, or if you're planning on buying a house in 2023, this type of information can give you some valuable insights and help you make strategic decisions in the months ahead. Here's what we're going to cover in this video. First, we'll talk about why the Bank of Canada is expected to hold rates steady in 2023. Then we'll talk about what this could mean for variable mortgage rates and fixed mortgage rates. And third, we'll talk about what could happen if the underlying assumptions in this projection are wrong. My name's Trevor Tardif, and I'm doing my best to make sense of all the madness in Canadian real estate, and more specifically, Edmonton real estate. If you like getting tips, updates, and insights about the Edmonton real estate market, make sure to like this video and subscribe so that other people just like you can discover this video. Now, if you're considering buying or selling a home in the Edmonton or surrounding community in 2023, you can go to booktrevornow.com and select a time on my calendar to schedule a free strategy call with me. You can ask me anything that you want about buying or selling a home, about different market areas, neighborhoods, that kind of thing. It's completely free. There's absolutely no obligation. All I hope is that later on, if we click, you could become a client. Just go to booktrevornow.com to select a time on my calendar. All right, let's take a look at a few of the highlights in the BPO's Economic and Fiscal Outlook for 2023. In the report, one of the highlights says, BPO expects the Bank of Canada to maintain its pause, holding the policy interest rate at 4.5% through December of this year. With CPI inflation solidly on track to return to its 2% target, we then expect the bank to start lowering its policy rate in January 2024, returning the rate to its estimated neutral level of 2.5% in December 2024. So they seem to think that we're on target for the inflation rate to drop, which is essentially why they're expecting the Bank of Canada to not increase rates anymore. And they're also saying they expect them to start lowering rates in January of 2024 by a full 2% by December of 2024. So if this turns out to be true, how will that affect mortgage rates? Well, variable rates would go down, but not necessarily fixed rates, since those are tied to the bond market. So does that mean that it would be a good idea to get a variable mortgage now instead of a fixed rate for 5 years? Well, I'm tempted to think so, but what's best for you is going to depend on your appetite for risk. 5-year variable rates are sitting at about 5.8 to 6.15% right now, depending on whether it's insured or if you've got a bigger down payment. So if the PBO's projection is true, that could mean variable rates could go as low as 3.8% by the end of 2024. Whereas if you lock in at a 5-year fixed rate, which is sitting at about 5 to 5.3% right now, you're still gonna have a good 3 years left on that rate by the end of 2024. Now in that scenario, you could refinance at a lower rate, but depending on where you got your mortgage from, your early payout penalties could vary substantially, and in some cases make it not worth it at all to break your mortgage for a lower rate. Typically, the big banks are going to have bigger early payout penalties. So if you're wanting to go with an option that allows you to refinance later for a lower rate and not pay a huge penalty, you might want to consider getting very clear on exactly what the terms are and how your mortgage payout penalty is calculated. Now, this is something that you're going to want to talk to your mortgage broker about to make sure you know before you proceed. Now, if you're trying to see where fixed rates are going, what you want to do is watch the Canada 5-year government bond, which has actually been going up since about mid-January. Now, if you look just in the last 3 months, you can see it peaked basically at the beginning of January, and then by mid-January, it had kind of hit a low, and it's been going up since then. Now, as much as we all like forecasts and projections to be true so that we can make plans and have more certainty about the future, the reality is that they're often wrong. Just think back to how a couple years ago they told us that interest rates were going to stay low for a long time and we should all go out and borrow a bunch of money with confidence. Or when they told us that inflation was going to be transitory and not that big of a deal. You get the idea. So what if they are wrong? Well, in my mind, if inflation kicks in real hard again and the Bank of Canada decided to start raising rates again, then this projection from the PBO would actually be wrong, and going with a variable mortgage rate would actually lead to higher rates down the road. So again, it depends on your appetite for risk, Pick your own poison. Now, I'm recording this video on March 6th, and the Bank of Canada is actually going to be doing another rate announcement on March 8th. And there's a good chance you're watching this on March 8th or later. So by now you can actually check to see if the PBO has already screwed up their projection if the Bank of Canada decided to actually raise the rate on March 8th instead of keeping it steady. All right, let's check out another highlight from the report. Following a stronger than expected performance in the second half of 2022, PBO projects the Canadian economy to stagnate through 2023. As the tightening of monetary policy takes hold, we expect a further decline in residential investment and weakness in consumer spending in the first half of the year. So this goes to show how come they think we're on track to hit the inflation target of 2%, because they're actually expecting the Canadian economy to stagnate throughout the rest of the year. So if that happened, that would obviously have an impact on reducing inflation. I would say that's one of the big pieces of this report. And we're just gonna have to see how this plays out in the real estate market. In Edmonton, at least, I'm seeing some pretty good demand right now, but of course, time will tell, and that can always change. It takes a while for these things to have an effect on the real estate market. Last year, we saw things change multiple times. Even though real estate is a little slower moving than the stock market or the bond market, it still sometimes feels like it can move on us pretty quick like it did last year. Now, if you got value out of this video and you'd like more, you might want to check out this other video about how Canada's housing affordability might actually get worse, or this video that shows how the Edmonton real estate market has been changing quite quickly in just the last month for people looking to buy single family homes. Thanks so much for watching, and I'll see you on the next video.